Hey guys, Nathan from Buyers Club here. Just wanted to put this video together to take a closer look at the recent discussion around changes to the capital gains tax discount, which are apparently under review ahead of the next federal budget later this year. There does seem to be a lot of support for the idea. Property investors are often an easy political target, and for younger voters or for anyone feeling the pressure of housing affordability, which is definitely a large share of the country, it's not hard to see why a proposal that can be framed as targeting investors might be a popular one. However, I think the potential effects here are far more complex than expected. And in this video, I want to walk through a few charts and some statistics to explain how I think this might play out. This latest round of debate was reignited by the OECD's annual survey of the Australian housing market. You can see the headline here and the excerpt from this article about the OECD's report, which says, in a section titled The Tax System and Subsidies Boosting Housing Demand, it notes that home ownership as an investor is further supported by a 50% capital gains tax reduction, as well as mortgage interest deductibility for investment purposes and the provision for negative gearing. The OECD recommends removing some of the favorable tax treatments of residential property ownership, including capital gains tax concession and negative gearing, which would help to cool demand and could help to mitigate upward pressure on house prices. And the argument you'll often hear goes something like this, that if you look at the long-term trajectory of Australian house prices in a chart like this, it appears that around about 1999, when the 50% capital gains tax discount was introduced, prices suddenly took off and began growing much faster than they had up until that point. At first glance, this does look very compelling, especially when you see a chart like this, but I don't think it really holds up for two reasons that I would like to quickly address. First is that when you zoom out and look globally at house prices, this pattern isn't unique to Australia. We're looking here at inflation adjusted house prices indexed to a common starting point in 1990 across a number of countries around the world, where you see a very similar shape across the globe for house prices over time. And that suggests that we're looking more at the outcome of forces that are much more global, things like credit expansion through lower interest rates and changes in lending standards, rather than a domestic tax change driving this outcome. If it really were the case that the capital gains discount were a primary cause of growth in the country, then I think Australia would look like much more of an outlier than it does. The second issue is a bit more subtle, but maybe even more important to be aware of. Charts like this one on the left here are often misleading because they encourage you to interpret this curve as an acceleration, as though price growth itself has suddenly become faster over time. But property prices grow through compound exponential growth. And when you visually plot compound growth over a long enough period on a chart, you will always get this kind of a shape, even if the growth rate is constant the entire time. And just to show you what I mean, on the right here is a chart that I made in Excel using dummy variables. The time period is exactly the same as the original chart on the left, looking across 1986 to 2025. I've indexed it as well to a value of 100 as the starting point in 1986, just like the real data on the left. But the assumption I've made is a constant 7% annual growth rate, since over the long run, that's around about what Australian property prices have grown at each year. There are no policy changes in this model, no demand shocks, no acceleration, just stable, constant growth of 7% every year. And yet the shape of the chart looks very similar to the one on the left. So at a glance, you might point to a chart like this and think, wow, growth has really accelerated from what it was back in the 90s. But you can see this same shape of chart with a completely constant rate of annual growth. Of course, I should say the level of growth in dollar value is not constant. Obviously, 7% growth on $100,000 is a lot smaller than 7% growth on $1 million. So the dollar value is getting larger each year, which does definitely matter from an affordability perspective. But this can happen alongside no change in the actual rate of growth each year. And this really matters because if the chart itself is being misunderstood, if we are looking at compounding rather than an acceleration, then the case for blaming the capital gains discount as a key driver of house price growth starts to look much weaker. With that in mind, though, we'll step away from the charts for a moment and take a look at a quick example to explain how this discount currently works and how it could look in the future under a proposed change. So in this example, we're assuming that an investor has purchased a $600,000 property, has held it for 2 years, and has then decided to sell the property that by then, just for round figures, has grown to a value of $700,000, which of course is a total capital gain of $100,000. Because this investor owned the asset for over a year, it means that under the current system, they are eligible for the 50% capital gains discount. If we also assume that this investor is in the top tax bracket, which is 45%, then the way that we would calculate the tax under the current system is shown in the yellow line here in the table. They made $100,000 on the sale of the asset, but because of the 50% discount, only $50,000 is assessed as a taxable capital gain. So that means that the investor is taxed at 45% of $50,000, which works out to just $22,500 in tax. That's how the system works currently. Below that yellow line in the table, though, are a couple of potential scenarios for what the government might do if it follows through on the OECD's recommendations. We could see potentially a reduction in the level of the tax discount, and you could see here how that would look under the same assumptions from our example. If the discount were reduced to only a third or a quarter instead of 50%. That would mean a 33% discount would produce tax payable rising to over $30,000, while a discount of only 25% would mean an almost an extra $4,000 in payable tax. Then the last line in our table here is how it could look if the discount were scrapped entirely. And as you can see, that would double the amount of tax paid on capital gains, though this probably is a much more unlikely outcome given that it would be such a drastic change to eliminate the discount entirely. And it's not only property that this kind of a discount might apply to. It's worth also bearing in mind that reducing the discount to 25% is a policy that Labor have previously considered under Bill Shorten, so it wouldn't be entirely without precedent for them to return to that idea. And another component of that earlier plan from Labor was that the discount would be grandfathered in, which means, in other words, that all property purchases made before the tax change comes into effect would still be able to access the 50% discount on capital gains. So if that were to happen, it then wouldn't matter if your property was purchased way back in 2003 or just last week, because you bought it before the capital gains tax change came into effect. You can then still sell it at any future date and have access to the original full 50% discount. So it wouldn't be applied retroactively to people who already hold property. So that's a bit of the background that helps us to understand what the most likely outcome could be should the government decide to go ahead with this. But then, of course, the question is, what would that mean for the market going forward? And I think the answer to that question is definitely not what the OECD are anticipating with this recommendation. If this policy were announced as a grandfathered change, I think we would certainly see a surge of demand in the short term, with investors attempting to lock in the 50% discount before a reduction comes into effect. So across that period, at least, you would expect the market to become incredibly competitive, putting a lot of upward pressure on prices up until whatever date is announced as the cutoff point for the original policy. Then over the medium to long term, you would expect to see an increased reluctance for property investors to cash in and sell their property. I'd expect to see a growing tendency to hold on to properties for longer than what we've seen in the past. And we do have some interesting figures on how quickly a majority of investors tend to sell their properties after purchasing them. There was this report released last year by the Australian Housing and Urban Research Institute, which found that on average, 55% of all property investments are held for just 2 years. At which point, obviously, these properties re-enter the market as new listings, which creates additional liquidity and supply on the market, both for other investors, but also for buyers who are looking for a home to live in. So already there is a major willingness among investors to exit their investments pretty quickly. And that is a good thing overall for market supply. Currently, they have a tax incentive to hold the property for at least a year, but if we then make it more expensive to exit the investment, to sell the property, then this is going to mean that investors start holding for longer because they need to wait for more growth before selling their property actually becomes worthwhile. So, over the years ahead, the impact of this policy will probably end up being fewer listings on the market and less supply overall. And of course, a reduction in supply is what will put even more upward pressure on price growth. From a rental perspective as well, disincentivizing property investment in this way will make real estate less attractive to new investors, which means less rental supply, which again puts more upward pressure on rents. According to this data from the ABS as well, about 40% of lending for new builds involves property investors, which is really critical for the market because this is entirely new supply, not just the existing properties that are being relisted for sale. So overall, if we do see a reduction in the capital gains discount down to 25% from 50%, and the change were to be grandfathered in, we're likely to end up with a rapid increase in demand and probably more price growth in the short term before it comes into effect. And then over the years to follow, the only people to actually benefit from the policy will probably be, firstly, existing landlords who will benefit from the higher growth with less supply on the market, both in terms of house prices and rents as well. And secondly, wealthy new investors will benefit because they're going to be the ones who can hold properties for the long term without having to plan to sell their properties anytime soon. So overall, the major practical takeaway here, I'd say, is timing. If you're still thinking about investing, changes like this may end up rewarding people who can get into the market sooner rather than later, especially if any prospective change is to be grandfathered in. That doesn't mean rushing into a bad purchase, of course, but waiting and expecting that this kind of a policy change might help to correct the market and improve affordability probably isn't the best strategy. As always, though, let me know your thoughts. I'd love to know if you agree or disagree with my thinking here, and I'll see you in the next video. Thanks for your time.